Are you interested in investing but unsure where to start? Understanding the different types of investments is a crucial first step toward making informed financial choices. With so many options available, from stocks to real estate, it is easy to feel overwhelmed. But each type of investment offers unique opportunities and potential rewards. Also, every opportunity has its own risks. Knowing the differences and how each investment works helps you build a diversified portfolio and manage risk better. In this video, we explore 7 of the most common types of investments that are essential for every beginner investor to understand. So, let's dive in and discover how these investment types can work for you. Stocks, also known as equities, represent ownership in a company. When you buy a stock, you are buying a small piece of that company. As a shareholder, you participate in the growth and risk of the company. Stocks are one of the most popular investment types because they offer the potential for high returns over the long term. However, they can be volatile, meaning prices can go up and down quickly. Companies sometimes pay dividends, which are a portion of profits shared with shareholders, adding another way to earn. Stocks are traded on exchanges like the New York Stock Exchange and National Stock Exchange, where prices fluctuate based on supply, demand, and performance of the company. For many, stocks are a core part of building wealth and achieving financial goals. Bonds are debt securities, which means they are essentially a loan you give to a company or government. In exchange for your investment, the issuer agrees to pay you a fixed interest rate over a specific period. Bonds are generally considered safer than stocks because they provide a fixed income and are less volatile. At the end of the bond term, known as maturity, you receive your principal investment back. Bonds are commonly used to balance a portfolio and add stability, as they tend to perform well when stocks may be struggling. However, bonds carry their own risks, such as interest rate risk and credit risk, which can affect their value. Understanding bonds can help you create a well-rounded portfolio with predictable income. Mutual funds are investment pools where money from multiple investors is collected to buy a diversified portfolio of securities like stocks, bonds, or other assets. Managed by professional fund managers, mutual funds are a convenient way to gain exposure to a wide range of investments without having to pick individual stocks or bonds. They come in many types, such as equity funds that invest in stocks, bond funds that invest in bonds, and balanced funds that mix both. Mutual funds provide diversification and professional management, but typically come with fees, which can impact returns. They are ideal for investors looking for a diversified approach without hands-on management, making them a great option for beginners and seasoned investors alike. ETF, or exchange-traded funds, are similar to mutual funds, but with a key difference. They trade on stock exchanges like individual stocks. ETF track the performance of a specific index, commodity, bond, or a group of assets. Because they trade like stocks, ETF offers flexibility. You can buy or sell shares anytime during trading hours. They are also generally more cost-effective than mutual funds, with lower fees and tax efficiency. Many investors use ETF to diversify their portfolios without needing to pick individual stocks. Whether you are looking to track the S&P 500, invest in a sector, or even explore commodities, ETF offer a wide range of options. REIT, or real estate investment trusts, are companies that own or finance income-producing real estate. Investing in REIT allows you to access the real estate market without buying property directly. REIT operate in sectors like residential, commercial, or industrial real estate and often pay dividends, making them a popular choice for income-focused investors. They are traded on major exchanges, similar to stocks, and offer liquidity that physical real estate investments don't. By investing in REIT, you get exposure to real estate's income potential and diversification without dealing with property management. This makes REIT an appealing option for adding real estate to a diversified portfolio. Commodities are basic goods used in commerce, such as oil, gold, or agricultural products like wheat and coffee. These are tangible assets that tend to perform well during periods of inflation because their prices usually rise when the cost of living goes up. Commodities can be bought in physical form, but most investors access them through futures contracts or ETF that tracks commodity prices. While commodities can provide portfolio diversification, they can also be highly volatile due to supply and demand changes, geopolitical factors, or even weather patterns. Adding commodities to your investment strategy can help protect against inflation and market instability. Derivatives are financial contracts whose value is derived from an underlying asset like stocks, bonds, or commodities. Common types of derivatives include options and futures. Options give you the right, but not the obligation, to buy or sell an asset at a predetermined price. Futures are contracts to buy or sell an asset at a future date for a set price. Derivatives are often used for hedging or speculation and can be complex and risky, especially for beginners. However, they play an important role in the financial markets by providing liquidity and enabling investors to manage risk. Understanding derivatives can help investors make informed decisions, especially when considering more advanced investment strategies.